There's a concept in psychology called loss aversion. And what that means is that people feel the pain of loss twice as much as they feel the joy of gains. So you don't see a lot of people asking, how long will the bull market last? But you see a lot of them asking, how long will the bear market last when stocks start going downhill? So we've attempted to answer that question today. And this number here, 9.7 years, reminds me of a very popular interview question asked at investment banks or Google, and it goes something like this: how many ping pong balls can you put in a 747? Or another question might be, how many manhole covers are there in the city of New York? And the idea is not for the candidate to answer the question correctly, it's to see how they think through difficult questions and use very little data to answer them. So that's kind of what we've done today. Now, the first thing we might ask is, are we actually in a bear market? And we believe that we are, based on the common definition, which is a 20% drop or more for one or more major indices. Now, if the drop is just 10 to 20%, they call that a correction. But if it's more than 20%, that's said to be a bear market. Now, there's also this notion of a recession, but we're going to leave that for the economists. For today, we're going to focus on bear markets. Now, by the way, all bear markets except one have been accompanied by a recession. So the last bear market, this is quite interesting. The last bear market was short-lived, and this was in March of 2020 when the world reacted to the pandemic, and that was very short-lived. It took 33 days roughly for these three indices to bottom. They both lost 30% or more in value, and then of course they went on charging upwards, and the bull market of the last decade or so resumed. Now, how we define bull market is certainly a different conversation, but these three indices made new highs based off of their previous highs prior to this last bear market. So peak to trough, this is what we're looking at. And if we ask ourselves, are these three indices in a bear market today? We could take a look and say, well, we need to compare that to the last high date. So the last time they hit a high, what date was that? And then compare that to the value that they have today. For the S&P 500, you can see that it's just entered bear market territory. For the NASDAQ, I think we can all agree that's been in bear market territory for a bit longer. And of course, the slow-moving Dow Jones Industrial Average, you can see here, is just approaching a bear market. So one thing that we need to consider also is that when we're looking at bear markets, how long it takes for them to bottom out. So the duration, according to CFRA, the S&P 500 bear market since 1946 have taken an average of 389 days to bottom, roughly a year, and then double that to return to their previous high. But there's a broad range here. So as we discussed earlier, the last bear market in early 2020 took only 33 days to bottom, and the dot bomb bubble bear market of 20 years ago required more than 2 years to bottom. So if we look at the bear market that we're in today, we're about 183 days in if we use the date of around, let's say, the end of December. And of course, these will have different dates, but you'll notice on this slide and others that they do move in pretty similar fashions. So we're in a bear market, no doubt, but one thing that we need to consider is how low the dip goes. So the worse the bear market, the longer it takes to recover. That seems quite intuitive, right? So when we look at the dot bomb disaster, that was a 75% index drop for the NASDAQ. So we pulled up a 30-year NASDAQ chart here that you could take a look at, and we drew the red line where the peak was in dot-com times and just moved that over. You can see around 2014, the NASDAQ reached the levels that it had been at after 14 years. So the lower the dip, the longer the recovery. That was a major market drop. So there was, I think Intel and Oracle were down around 80%. If you think about that, the average tech stock lost 75%. There were certainly a lot of firms that went bankrupt and lost a lot more than that. So this is something we need to consider. So the next question you might ask is, how low can this bear market go? Well, here's a question for you. In the 30 months that followed the pandemic, was $16 trillion in economic value created to offset the $16 trillion in value that was lost? And the answer is probably no. And if it was, that would mean that the market should just trade at what it was trading at right before the pandemic. So they're estimating, the IMF has estimated, the $16 trillion value, which, firms are just now starting to realize the impact because of a supply chain concept called the bullwhip effect. It takes a long time for shocks to manifest themselves in supply chain. So this, we're not hitting our expectations because of the Rona excuse is continuing on, and it's becoming even more valid, which is quite concerning. So if the market, let's say the economy didn't create enough value to offset the effects of the pandemic, then it should trade lower than it was before the pandemic. And on this chart, you can see where we've pointed out the minor blip, that last bear market that took place, where the indices lost roughly 30% and then quickly corrected. So it's reasonable to think that these three indices could trade at pre-pandemic levels. So here's how far they're trading above pre-pandemic levels right now. So not a whole lot. But then it's also reasonable to think that they may trade down to the March 2020 bear. So when the market initially reacted to the pandemic, we could revisit those levels. If we did, then these are the drops that would need to happen across all three indices. And that's quite interesting that they're relatively the same, but that's the sort of drop that we would need to see for these three indices to revisit their March 20 lows based on where they're at today. And that's certainly something that is reasonable to think that could happen. Now, if that did happen, then what we can do is we can look at the peaks that we mentioned before and compare them to that March 20 trough. What that gives us is the numbers you see here. So 51%, 48, 57. Well, we can actually take the average of that, which is 52%, and then use that to deduce how long it might take for the market to recover based on the last dramatic crisis that happened around .com time. So we know the .com crash of 75% took 14 years to recover. That's about 1 year for every 5.35% drop. So if these major industries trade down to the levels they reached upon the initial pandemic reaction, then this bear market should last roughly 9.72 years. That's how we arrived at that number. Again, as we said before, it's not important to have an accurate number. It's important to have a number. And you learn that in B school when they make you go through what's called case studies. So they give you limited amounts of information and say, come up with an answer. And that's what we've done today. Now, what we're doing with our own portfolios, first of all, we're loving dividend growth investing. And we always have. It's been where the majority of our money sits. And the average stock in our 30 dividend growth stock portfolio has not only paid dividends for 44 years, they've increased them every single year. That's incredibly remarkable. And then we're also using some dry powder that we have to add quality companies. I just wanted to put a couple examples of companies right now that look appealing. And one is UiPath. We've written extensively about them, and I'll put a link to a prior article on UiPath in the description of this video, along with the article used to produce this presentation. And UiPath is all about saving other companies money. And when you're selling a solution that saves other companies money, it sells great in a bull market. It sells better in a bear market when everybody's purse strings tighten. So we really like UiPath based on that philosophy of a firm that helps other firms save money. We've also noted 3M here. I don't recall a time when 3M's dividend was around 4.6%, and I haven't actually looked at a historical chart of 3M's yield, but that's pretty compelling, and this is an excellent firm. So they're a conglomerate, which means that they're a portfolio of companies which provide internal diversification. It's a very attractive dividend growth stock, and their yield, for whatever reason, currently sits around 4.6%. That may imply that investors don't believe they'll be growing their dividend as fast as they have been growing it, but it's certainly worth a look. And then lastly, in terms of how we're analyzing tech stocks, we're pivoting more from a focus on growth to survival. So for example, we're starting to look at things like gross margin. So how profitable is their business if they trim the fat? Or runway, how much cash do they have on hand? And based on their burn rate, how long will they last? And if they're a firm that's not profitable, that tells you whether or not they may survive without having to raise capital, because in a bear market, raising capital is difficult for any number of reasons. So just to conclude, I think we can all agree we're in a bear market. The bigger the trough, so the further we fall, the longer it's going to take to break even. And for younger investors, that's not an issue. Actually, that's a good thing if you have an income, because then you're able to dollar cost your way average into positions and create wealth for yourself. If you're an older investor, that's a bit problematic, because you may have to sell some of your assets to live on, perhaps in retirement. So there's a little bit of a concern there that you don't want this to last as long as 9.7 years at least. So we just know the bigger the trough, more likely the longer it'll take for the prices of these indices to return to their previous highs or break their previous highs. But if you're holding quality companies, you really have nothing to worry about. And this is a great opportunity to add to those positions. So please put your comments in the comment section. Thanks so much for taking the time to watch this video today.